Retailers have reported their Q1 earnings. Research Director Shiraz Mian here now with an update on that and more as we wrap up this earnings season. Shiraz, by the looks of things, even though consumers are still spending, it seems they're being more selective in their purchases. And I think that's evidenced in the Foot Locker and Gap strong results beating expectations. But then on the flip side, Kohl's, which may not have been able to chase the retail or consumer trends. What, if any, clues to future consumer resilience and economic health did this wave of retail reports carry with it?
Yeah, thanks for having me, Terry. The consumer spending trend is still stable, as you put it. There are signs that in some segments there's stress, as we can intuitively appreciate after 2 years of inflation, and we are seeing that in the results from a number of these companies, like you mentioned. But it's not all bad. There are signs of improvement in some categories as well. So one recurring theme we had been hearing from retailers over the last 4 to 6 quarters in the post-COVID period was this persistent softness in discretionary spending, and that was in apparel, in footwear, in big ticket items. Pretty much all discretionary categories have been struggling over the last many quarters, and now a number of retailers came out with relatively reassuring and positive outlook on that front. So of the big players, you and I have discussed Walmart and Target in the past. Costco has since reported results. Costco, as you know, leans a little bit higher end on the income distribution, and they saw a lot of strength on the discretionary side. Target is also relatively higher income and leans discretionary, and they saw stability on that front. Best Buy, relatively bigger ticket items, same story on the whole. Still weakness overall, but some discretionary categories starting to show sign. And then at the lower end, we are seeing consumers are still spending, but they are more watchful, and we are seeing clear signs of that. The Dollar General that you would clearly put in the as the outlook for the lower income side had very strong foot traffic, but they mentioned that the basket size, the items in the basket, are on the weak side, and they typically associate that with stress in their audience.
So on the heels of these retail earnings this time around, what does that sector look like as a whole right now?
So on the whole, companies struggled to beat estimates relative to other recent periods. Like on the earnings front, they beat by 72.7%. On the revenue side, they beat by 63.6%, meaning that of all the retailers in our retail sector, 63.6% beat revenue estimates. And that's below average. The EPS beats percentage is also below average. If we look back like the last 5 years for these same retailers. On the growth front, the picture isn't that bad. In fact, since we have Amazon in the retail sector, and Amazon is one of the Magnificent Seven players, the aggregate earnings and revenue growth for Q1 was 29.7% and 5.4% for the sector as a whole. But once you take Amazon out, then earnings growth declines to minus 0.7%, and revenue growth drops to 3.6%. So you could see that while they're still spending, and you're seeing sales growth and top line growth, there's plenty going on in the line items that's compressing margins and profitability for the group as a whole.
And let's widen out a little bit. Recap the overall scorecard for the big earnings picture.
So pretty much done with the Q1 earnings season. In fact, we are gearing up to start counting the Q2, but it's never done, as you know. We have 3 companies still to report Q1 results, even though we have started counting companies that we consider as part of the Q2 tally. But 7% earnings growth, Terry, for Q1, 4.3% revenue growth, 78.3% beating EPS estimates, and 60.6% beating revenue estimates. The growth picture, the earnings growth picture improves somewhat if you exclude energy from the mix, and it drops really in a major way if you exclude technology from the picture. But on the whole, as we discussed in the context of retail, companies have been struggling to beat estimates.
Are you happy with the way revenues and margins turned out?
On the whole, yes. In fact, margins, how companies have performed this earnings season and also in the last couple of earnings seasons has been the unsung hero, I would say. Companies have done an excellent job, and we are seeing that the year-over-year declines that was a persistent theme that ended obviously in Q3 last year, and the comparisons have been positive, just barely modestly positive, but nevertheless positive, and we saw that trend continuing in this earnings season as well.
How would you characterize the corporate guidance picture for Q1?
So not great, but not bad either. On the whole, like we were discussing in the context of retail, no company told us that consumers are holding back. They're hunting for value. They're going up or going down in the value, but they're still spending, and that's what we heard from tech and from most other sectors as well. And this has been a recurring theme on the earnings front lately, and that is showing up in the revisions trend for the current and coming quarters as well.
I've heard that guidance for the year, for the most part, is set by companies by the end of the first quarter. Is that true?
Yes. So typically, unlike other quarters on the earnings calls, analysts will probe a lot more about how the companies see the rest of the year evolving. Not every company will give you guidance if they do provide some visibility. It's typically only about the next quarter, and then some companies have the reputation for being transparent. But yes, on the whole, on the Q1 earnings calls, management have relatively more clarity on how they see the picture evolving, and some of them will share that with us too.
All right, let's take a quick look at Q2, because you mentioned Q2 a few times. Analysts have increased estimates for S&P 500 companies for Q2 during April, but then lowered them for Q2 during May. Do you think they're going to continue revising lower during June?
So it is ticking down a little bit, Terry, but on the whole, the revisions trend for Q2 as well as for the full year 2024 has been very positive. In fact, unlike any other recent quarters, the estimates have barely budged in the aggregate. We're looking for 8.7% earnings growth in Q2 on 4.6% revenue growth. Now, the 8.7% is down from 8.8% that was expected at the start of the quarter. So barely changed, though it wasn't just staying there. It went up to 9.6% and has come down, as you pointed out, that in May. So I would expect some further downward adjustment as companies discuss their outlooks and as analysts have more confidence about their estimates. But on the whole, the trends on the revisions front has been one of the positive features of this earnings season.
All right. So to recap now, since we're coming up to the end of the Q1 season, what does aggregate earnings growth look like for Q1 and then Q2 and beyond?
So the picture is improving. As you know, earnings were declining for the first half of 2023, most of 2022, and we just barely got our head above water in the second half of last year. So as I mentioned earlier, on an ex-energy basis, we are essentially at 10% growth, and it's 8.7% growth expected for Q2. As you know, more than 2/3, more than 3/4, in fact, companies beat estimates. So I wouldn't be surprised if Q2 will eventually be in double digits as well. It's not gangbuster growth, but it's far better than what we have been seeing over the last 6 to 8 quarters.
All right. Want to remind our listeners, too, that they can keep up with your written commentary by going to the homepage of Zacks.com. With Shiraz Mian, I'm Terry Ruffalo.
This material is being provided for informational purposes only, and nothing herein constitutes investment, legal, accounting, or tax advice, or a recommendation to buy, sell, or hold a security. Do not act or rely upon the information and advice given in this podcast without seeking the services of competent and professional legal, tax, or accounting counsel. Publication and distribution of this podcast is not intended to create, and the information contained herein does not constitute an attorney-client relationship. No recommendation or advice is being given as to whether any investment or strategy is suitable for a particular investor. It should not be assumed that any investments in securities, companies, sectors, or markets identified and described were or will be profitable. All information is current as of the date herein and is subject to change without notice. Any views or opinions expressed may not reflect those of Zacks Investment Research as a whole.